guest expects continued volatility for both Philippine bonds and equities on the February rate cut expectations. Well, with us now for more is Angie Pacis, the CEO of AIA Investment Management Philippines. It's good seeing you again, Angie. Welcome back to the program.
Happy to be here, Kathy.
All right.
Thank you.
So what do you make of the peso's intraday high there at the open of 59.38 and now at about 59.41 to the dollar?
Okay, so the BSP forecast for the peso dollar rate was really between 58 to 62. And you have a lot of factors pointing to, the upper end of that range being tested. Well, immediate catalyst last night was, inflation coming in and signaling that really the expected rate cuts in the US will happen later and there will be less, right? And since June, the interest rate, the difference between peso interest rates and US interest rates have been narrowing. So that's actually going to favor the dollar. So that's one thing. And of course, long-term driver is really the growth differential, right? While the US economy is showing strong signs of staying strong, we've just downgraded our growth, and we're actually one of the few countries in the region who is downgrading our growth forecast. So that coupled with, let's say, a downgrade in a balance of payments forecast, largely coming from weak sentiment over the corruption scandal. All of those are actually going to put pressure on the peso on top of your current account deficit.
Yeah, I know. We're going the other way when we're compared to the ASEAN. So how low do you think the peso would get before it forces the Monetary Board to rethink either the pace or the depth of its next easing cycle? As a lot are expecting at least a 25 basis point rate cut next month.
Okay, the primary focus of the BSP is always inflation targeting and, of course, financial stability. So if they do intervene in the FX market, it's not really so much to target certain levels, but to make sure that, the financial sector becomes stable. So I guess they'll just be there to smooth it out. But to really, pin a particular number, I really don't think so. What will prompt them to move? Well, of course, primarily inflation expectations. And we're actually of the camp that, for now, based on what we see, maybe the rate cut in February is actually iffy, simply because, the BSP is already within their target 2 to 4 range. And in fact, core inflation is higher than headline inflation. So what will actually trigger it? If, let's say, growth slows down to the point that, that inflation expectation tilts to the downside. But until then, I think, the US, the BSP will be data dependent.
Right. As journalists, we're actually dependent on what the governor says, because in a span of 5 months, the good governor has communicated in as many ways that the easing window is shutting soon. He reiterated last week, if I could just pull that up, he says we're very close to where we want to be. And then last month, he mentioned that this could be the last cut. And then back in August, he mentioned that the easing cycle is nearing its end. So you're saying that February may be iffy in terms of a rate cut, but how are you interpreting the guidance that he's giving and the actions that have come forth so far?
Okay, so it's really about, again, of course, the governor will be circumspect about what he says, right? Because, everybody follows what he says. But I think if we follow the data, they've always been true to form. It's about managing inflation expectations. And right now, where we are, they're already in their target range. So, so that's why I guess he's slowly easing the news that unless there's something there that, points to an inflation, softer inflation that will allow them to continue to cut rates, I think we're pretty much done.
Right, and that poses as a problem when you see an economy that's trending lower. You're expecting sub 5%, not only for the fourth quarter, but also for this year? I mean, how much slower do you see
Five.
the economy growing in the first 2 quarters at least this year? And the recommendations you have for clients positioning between stocks and bonds?
Okay, so just to correct, 4.6 is fourth quarter. We're looking at 4.9 for the full year 2025. For 2026, we're going by the BSP forecast of 5.4%. A lot of it is also, of course, base effects, right? You're gonna come from a very low base. So yeah, so how are we expecting? So we for the last 2 years, it's been a roller coaster ride for the markets, right? Whether it's a little less for fixed income, but it's been a roller coaster ride. So what is actually saving the day every time the stock market dips? That your valuations are actually very, very low. So essentially, if there's any weakness, you see bargain levels again. We just pick up actually. Right now, our stance is defensive. We're slightly underweight on equities now. We've been using the strength to unload a bit, but we will come back actually. So, sometimes making returns in the stock market is really comparing what you're going to pay and what you expect future prices to be. And when it goes below a certain level,
It's an
and when
art
it goes
form.
yes.
And also determining
but-
the sort of yields. I'm just curious because I know we talked about this last year. Your adventurous fund, the Peso Conservative Fund, and the Peso Balance Fund. How much money did you make for your clients at a very difficult year in 2025?
Okay, so our conservative fund, those are multi-asset funds, but that's the least exposure to equities. We actually generate a full net return of 4.13% for the conservative fund. For the balance fund, which is a mix between, of course, a slightly more tilt to equities, we made 2.13%. And for our adventurous fund, the most exposure to equities, we ended up flat for the year.
All right, well, that's fair enough. People have made money despite all the risks. And I
Yes.
wish you well in 2026, and I'll check back with
Thank
you
you.
on those yields.
Same
Thank
to you,
so much.
Kathy.
Angie Pacis of AIA Investment Management Philippines.